Stop what you're doing. If you own Alarm.com or are even thinking about buying it, you absolutely need to see this 5-model valuation breakdown. Look, I get it. The biggest fear we all have as retail investors is getting trapped in a maturing tech platform that's secretly running out of steam. It is a terrible feeling, right? But last week, I ran this stock through 5 models and 2 legendary checklists. And honestly, what I found completely shocked me. By the end of this explainer, you'll know exactly if Alarm.com is a classic Peter Lynch value trap or is screaming Warren Buffett buy. We are looking at a true anomaly in the market right now. And it all starts with a rather shocking statistic: 91.74%. That is the massive chunk of this stock currently owned by institutional investors. With Wall Street's smart money holding an absolute stranglehold on the company, it begs a really bold, almost uncomfortable rhetorical question. What exactly do they know that we don't? Are these massive funds seeing a fortress-like business model that the rest of the market is just totally blind to? Or are they quietly holding the bag on a declining asset? Well, get this. The consensus analyst fair value sits at $58, while the current trading price is hovering right around $45.37. That means this stock's intrinsic value could be roughly 30% higher than what it's selling for today. It's a bit like finding a pristine, high-performance sports car sitting at a used car lot discount. But is it actually a deeply undervalued fundamental buy, or just an optical illusion hiding deeper structural flaws? Today, I promise you a clear, actionable framework you can steal to analyze this duality for yourself. Section 1. Q1 2026 Financial Highlights. Okay, let's dive right into this. To understand if that 30% upside is real, we gotta look at their most recent earnings. And on the surface, the top-line numbers paint a super bullish picture. But if we break it down, it gets even more interesting. We aren't just talking about one-off hardware sales here. We are looking at the holy grail of tech, SaaS and license revenue. That recurring software revenue jumped to $181.5 million. That's a 10.8% year-over-year jump, which tells us their connected properties platform is still actively acquiring and, more importantly, monetizing users. But here's the real kicker. They are making actual, real money, specifically $49.6 million in non-GAAP adjusted EBITDA for the quarter. So we're definitely not looking at some cash-burning, hypergrowth startup that's going to continuously dilute your shares just to keep the lights on. No way. This is a highly profitable, mature enterprise generating serious earnings. And they're not just sitting on that cash either. They're aggressively reinvesting it. Through their OpenEye subsidiary, they've just launched AI Visual Check to totally automate safety monitoring. Add in their new in-app automation suggestions, plus location insights for way faster emergency responses, and you can see exactly how they are actively widening their technological moat. Section 2. The Institutional Stronghold. So the financials look rock solid, the product pipeline is packed, but let's circle back to that massive institutional ownership we talked about earlier, because this is where the plot really thickens. When we track the flow of that money over the last 12 months, despite institutions owning almost the whole pie, there is massive selling pressure. Just look at this discrepancy. We've got $405.16 million in institutional buying, right? But that is completely dwarfed by over $955 million in institutional selling. Outflows are literally more than double the inflows. Major players like Lazard Asset Management are aggressively reducing their positions. Which brings us to what I think is the absolutely critical question of this entire explainer. Can Alarms.com actually sustain its software profitability? I mean, if the numbers look so great on the surface, why in the world is the smart money quietly heading for the exits? This is exactly where the bear case starts to take shape, and we really have to confront the reality of tech market saturation. Section 3. Emerging SaaS Headwinds. To figure that out, we have to peel back the top-line revenue and dig straight into the operational efficiency metrics. A deep dive analysis from Simply Walsen exposes some pretty noticeable cracks in the foundation here. There is a massive fundamental tension happening right now. On one hand, management is projecting total confidence, literally raising their full year 2026 revenue guidance up to $1.07 billion. But on the other hand, the underlying operational data is kind of dragging them down. We're seeing completely flat operating margins and, really critically, weaker billing trends. Now, if you aren't super familiar with SaaS metrics, let me explain really quickly why this is a huge deal. In a software as a service model, billing trends act as your ultimate leading indicator. It measures the actual cash being invoiced for current sales and renewals right now, today. So if billing demand is going soft, that is a glaring red flag that future recurring revenue and profits are eventually going to take a hit, even if today's income statement still looks perfectly healthy. Simply Wall Street hits the nail on the head here, highlighting the root of the problem: shifting customer price sensitivity. The smart home and commercial security markets, they're maturing really rapidly. Competition is heating up. If Alarm.com can't easily push price increases, or if they have to spend significantly more capital just to acquire and keep every single subscriber, well, those flat margins are going to become a severe drag on the stock price.
Section 4. Valuation and Forecasts.
So we have a really strong bull narrative built on AI innovation, clashing head-on with a bear narrative focused on softening demand. To break the tie, let's just run through a rapid-fire fundamental breakdown. A trailing PE of 18.83 is actually quite reasonable, but a forward PE of 16.18, that makes the stock look remarkably cheap for an established tech company. Plus, an enterprise value to free cash flow ratio of 13.69 highlights that they are generating over $168 million in free cash flow. By traditional valuation standards, the market is absolutely priced in a massive amount of pessimism here. And when we look at their overall financial stability, they are actually heading into this period of potential SaaS headwinds with a massive war chest. They're sitting on nearly $500 million in cash and equivalents, $499.35 million to be exact. Now, yes, that is slightly outweighed by their total debt load of $566.73 million, which leaves them with a net cash position of negative $67 million. But honestly, given their incredibly strong ongoing free cash flow, this is a highly manageable balance sheet. They definitely have the financial resources to weather a storm. Which leaves us with one final multi-million-dollar question. Will Alarm.com's massive cash flow and aggressive AI innovations outpace the heavy reality of customer price sensitivity and a saturated smart home market? Well, you now have the framework and the hard fundamental data. So look at your portfolio. Are you staring at a classic value trap illusion or potentially the greatest tech buying opportunity of the year? I'll leave that for you to decide.